Harry Dent as our opening keynote. Then we're going to go into presentations. Then we got a couple other panels, and then a lunch, of course, in between the presentations. And tonight for our closing party, we're going to go to a restaurant called Kanya, which is next door in the El San Juan. And it's a beautiful little restaurant. Like many restaurants in Puerto Rico, it's very interesting. A lot of them are local-born chefs who had a family tradition of cooking. They then got sent off to New York to study at the Culinary Institute. They then went to Spain to then work at 2 and 3 Michelin star restaurants, and then they came back to open restaurants here. And it's like the meal you had last night, Javier, that's what he did. And he had a restaurant that unfortunately did not survive Hurricane Maria. Perhaps he'll have a future one, but right now he's catering, and so we were able to bring him in. He actually, for those of you who were here for the first year, that was his restaurant that we took over, La Haikita Baya. And tonight, Kanya is a really acclaimed Puerto Rico female chef. There's not that many of them in Puerto Rico, or actually anywhere with really kind of her pedigree. And so they have a very interesting little mix of tapas, and it's family style. And so that's where we're going to have our closing cocktail party. And then you can go and dance in the lobby again, because they actually have Sunday night salsa band, and I saw them a couple weeks ago. They're really, really good. Last night's band, by the way, the Charlie Sepulveda band, they're Grammy Award winners. So these are the kind of things you get on the island. It's kind of cool that people don't realize until they come here. And then Edge Block has got an after party at 10 o'clock in the Loiza district, which is kind of an interesting place nearby. A couple of years ago, it was kind of really a downtrodden neighborhood with almost nothing to do. I think they had 3 restaurants. Now they got 50 restaurants, and it's like the hip hot spot in town. And so they've got an after party at a place called Industry. So they've got little cards out front for that. It's a fundraiser for them. So Harry Dent, I met when actually I started reading his books in the 1990s, in the Roaring '90s, and really learned about economic cycles. And when you've been burned by an economic cycle or two, you're like, wait, this is starting to look familiar. And so I started reading Harry's books, and it started really making sense, and Elliott waves and things like that. And when he moved to Puerto Rico, he'd actually been here for years with a home in Culebra for vacations that he's been building for, I think, 175 years now that it's been building. He then decided to make this his permanent residence for the same Act 2022 reasons that many of us have here. A mutual friend introduced us, and he and his lovely wife and me and my lovely wife are all good friends now and hang out. And I go to his conference, he comes to my conferences, and it's another part of just a lot of people have asked me about moving to the island and like, will I make friends? I think my wife and I have made friends faster here than we did when we moved to Las Vegas, or she says even in her first decade or so in Los Angeles. So at any rate, so be prepared for a gripping presentation on how demographics is the future and the economy, and you can close your eyes once in a while if it gets too scary, but Harry Dent.
Good morning. I am going to be talking about economics. I will also give my outside view of what your industry looks like to me, because that's what I've done all my life. I've been more a business consultant, and I'm actually not an economist by training. I started out in college, and I was into cycles early on, and I became an economics major, and I only lasted 3 courses and said, the hell with this shit. I mean, economists don't agree looking at the same facts. Nobody can understand them. They get so involved in all their detailed indicators that they literally miss the obvious, the forest for the trees. And the ultimate caveat for me is the ethos in the economics profession is nobody can predict the future past the next election. And I'm like, well, what the hell do I need you guys for? You know, so I just quit. So I go to my father, who's in politics, and so he knows all types of rich donors, and I said, well, talk to your friends. What should I take? I'm done with economics. What did they tell me? Accounting and finance. So I took accounting and finance. Never regretted that. All these business people, that was the thing they wished they had taken. But I didn't want to be an accountant, per se. So I decided I wanted to go to Harvard Business School. Well, I had to work for 2 years. I worked for a large corporation. Oh, Jesus, 2 years was a long 2 years. I went and did my 8 hours of work in 2 hours, then just went and hid in the library because I didn't want to upset the apple cart for all these bureaucrats pretending like they're working all day. So I knew that wasn't the future. And so I did get into Harvard Business School. I wanted to go to Stanford, but they wouldn't take me, so I had to take Harvard as a second choice, which was perfect for me because it was all about the case method. There was no theory, no nothing, no teaching, just 80 people in each class arguing from all angles, and you had to have at least 2 years. That's why 2 years. You had to have at least 2 years of business experience in the real world to go there, and many people had more. So all these people just arguing. And I'm like, shit, I was good at that. I know. I was good at dancing on my feet, arguing, thinking outside the box. And so I said, okay, I can't work for big corporations anymore. So I came out and I worked for Bain & Company. Bain, McKinsey, Bain and BCG were the up-and-coming global consulting firms to Fortune 100 companies with a new method, which I'll talk about here, just the 4 stages of business. And the secret to that was very simple. Businesses go through these stages, and the reason most businesses fail is the season or the stage changes, and they're doing the same thing they did in the past stage, and it ain't working anymore. So we would come in from the outside, know nothing about their industry, learn it very quickly, and then decide where they needed to make switches or not, and made huge changes. But at Bain & Company, I'm still working for large, dinosaur, slow-moving, bureaucratic companies, even from the more exciting angle. So I couldn't do that after 2 years. And I took a job turning around a company in California that I got through a friend, and then just ended up consulting, did the same type of Bain & Company consulting to new ventures. Now in Harvard Business School and at Bain, I learned this kind of S-curve, 4-stage model, and that really was very important stuff, very powerful stuff. But it wasn't until I worked with new ventures that I started to see how S-curves progressed early on, like your industry, where they go. But more importantly, I tripped on the baby boom generation in the early 80s when they were young, when they were just starting new industries. And I wasn't working in the high-tech side or even finance, consumer-based industries in California, where companies were doubling in the early 80s recession, did not care about the economy, because they were on a new S-curve, meeting new needs of young baby boomers, starting new consumer trends. So I got to see the future. I realized very quickly, like anybody in technology, if you want to see the future, work with the people creating it. You're not going to see the future listening to Bill Clinton or the head of IBM or large companies and corporate CEOs. They're the path rolling forward, getting ready to die, because everything goes in cycles. So I always had a natural affinity for entrepreneurs. I've started my own business from scratch. I've invested in 15 businesses. Guess how many were successful? Just take a guess. 2 break even, 1 potential successful, 11 outright failures. I felt like a frickin' idiot till I talked to a guy I met in Calabria on my island, a billionaire who was at New Enterprise Associates when they funded Oracle. That's how he became a billionaire, one hit. He said, here, don't feel bad. We make it. We're the best. We get the best people. We have the best expertise. You're just out there with your dick in your hands investing in new ventures, okay? We only make it on 1 out of 11, but we get a 200-to-1 hit when we win. That's how they make money. So I felt a little better about that. But you're in an early stage venture. So I'm going to look, what did I find out about economics? Because what I do, I don't listen to economists. I don't look at government. I don't care what the Fed does. That's all short-term stuff. Governments react to trends. Consumers and businesses create growth. and create trends. 70% of GDP is consumer spending, and economists pay no attention understanding consumers because they think they're just Pavlov dogs. If you lower interest rates, bump, 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 we buy more. If you raise them, we buy less. And that happens to a degree, short term. So I study consumers and businesses. 10% of our GDP is businesses who only make investments if consumers are spending more, because they're not stupid and they don't want excess capacity, unless you live in China where that's okay, which is not going to work out well, by the way. 20% is government reactive. When we had the 2008 big downturn, which I predicted 20 years before it happened, to the year, end of 2007, just by baby boom peak spending, very predictable thing, what do? Just print money to cover it over. They reacted. They say, oh, they avoided the next Great Depression. Avoided? Like a heroin addict is coming down and takes more to get high again? That type of avoidance? Yes, you can feel good. You can create money, pour it in the economy. Does it create real growth? My answer is no. So what started in 2008 is going to finish in the next few years. That's going to be very good for this industry, but I think, I'm going to look at my view of what's going to happen. I think you're going to see perhaps another super bubble just ahead, and then another big crash. And then my view is you are like the internet 20 years forward. The next big thing, but the internet was in your stage in 1999. Amazon just went public, I don't know, late 98 or something. And biggest bubble ever back then. You guys have trumped that, by the way. Your bubble is bigger than even the tulip bubble. I'll give you a quick, I was just speaking in Whistler for Tony Robbins' Platinum Group. I do it every year. Best group I speak to, 400 crazy-ass, fun people who are successful entrepreneurs by accident, I think, because they're not business-type people. And Tony did a little exercise. He created a bubble right in front of people. He says, okay, here's the game. I got a $100 bill, and whoever bids the highest, in the end, gets this $100 bill, but the catch is the person with the second highest bid has to honor their bid. So the bidding started. Slow at first, bubble, bubble, bubble. Greed, ego, people like, okay, I'm going to be in this game. You know, have anybody watched Deal or No Deal with Howie Mandel? Fucking everyday people get up there and balls the size of coconuts when they get on that stage on national TV. And bet, and bet, and bet, I'm going for the thing. Against the odds, they make terrible decisions. I want you to guess for $100 what the top bid was before the bidding stopped. Huh? 60,000. Close. 100,000. The second bid was 50,000, and that guy did have to pay $50,000 and didn't get the $100 bill. The guy that bid 100,000 got the $100 bill. That is the same ratio of tulip bubbles in 1637 or whatever it was. That little bubble where $2 tulip bulbs went up to $2,000 in 1 year. Same 1,000 to 1 ratio, just on a bubble. People buying because it's going up, not because the fundamentals support it. Tulip bulbs are still worth $2, but they got up to 2,000, just like this thing. So I look at demographic cycles, technology and business cycles, and I have become, in the last several years, an expert on bubbles because we're in a bubble era. And if you don't understand bubbles, you're not going to see what's going to happen. Bubbles are not black fucking swans, okay? They're not. Economists don't understand bubbles, and when you get one, they say, well, nobody could have controlled it, and nobody could have predicted it. Nothing more predictable than a bubble. Nothing more obvious. Is Bitcoin become obvious in the last several years? It's the biggest bubble, bigger bubble than tulip bulbs. The biggest, but bigger than the internet bubble in 99. So is this obvious thing? Do you say, oh, what, I can't even see this? Do bubbles do what? Do they always crash? Doesn't mean they end, they crash. Anything that goes up that extreme, because cycles go up and down in same ratios. It's just a super cycle. And it's a sign of an early stage industry. What tells me that Bitcoin, cryptocurrencies, and blockchain is the next big thing is the size of this initial bubble. That says something. That doesn't happen in most industries. So it's a very good thing this is happening, but get ready for a roller coaster. Now, my view of the world is simple. Everything runs in cycles. Everything has a life cycle. People, technologies, anything. The weather, does it have a cycle? The sun have a cycle? You know there's a 100,000-year cycle in weather? Do you know there's a billion-year cycle in weather? Spring, summer, fall, winter. Just gigantic. Everything runs in cycles. This is what I focused on, the consumer cycle, and it's important since World War II because the first middle-class generation emerged, the Bob Hope generation, after World War II. We didn't have a middle class before Henry Ford realized, excuse my French, that people are morons, and if you have them do one thing simple and put them on a highly complex assembly line thing, they become 10 times more productive. So he made low-skill jobs highly productive, created a middle class that did not exist before that, and made people more important, 10 times more important. So demographics have always mattered, but I look at history, technology cycles, commodity cycles have been more important, but not after World War II. So people enter the workforce, have kids, peak in spending when their kids leave the nest, start to save for retirement, then retire, and then they die. That's the cycle. How predictable is that? Incredibly predictable. Ask a life insurance actuary how predictable people are. In the US, the average person will die at 78.6 years old. Now, if they're older, that'll be later. But they have it down to that. Men and women are different. It's a science. The trick is averages. I can't predict you when you're going to die, but a life insurance actuary. I can do that for everything else, cradle to grave, I'll show briefly. When people do everything at peak is predictable. When they buy potato chips, anybody guess when the average family spends the most money on potatoes? Just take a wild guess. Remember who they're spending it on. It's 42. Calorie intake peaks at 14 for the average kid. Average baby boom family had their average kid at 28, 28 plus 14. I can add up the logic, but I go to the actual research, and 42 is the peak. When do people weigh the most? Guess that. 60. Then it falls off. Why the hell do you think you see Marie Osmond on every other frickin' commercial? That's big with the baby boom now. They're past their peak spending, but now weight is the big thing. The next thing is going to be miracle vitamins and pharmaceuticals, and then it's going to be nursing homes. Nobody's going to build enough nursing homes here or anywhere. So people are predictable. People create cycles. They're 70% of GDP. So where do I start if I want to predict people? They got to be born, right? Isn't that where it starts? Real quickly, a little extra insight. What actually drives our economy? What has to happen before people are born? Just kind of has to happen. Somebody has to have sex, right? Sex drives our economy. You wondering why economists never figured this out? 9 months, baby, 46 years, I'll show peak spending. For the baby boom, looks like 47 for the millennials and 48 for the people a little older than them. So I take birth cycles, and in the US and countries that have high immigration, I adjust for legal and illegal estimated immigrants, because I got a bell curve of ages of immigrants. I can take 1 million immigrants in a year and plot them when they were born and add them as if they were born here. So this is baby boomers or births and births of immigrants that now live here. You see that thing in the middle? That's called the baby boom. First, we had the Bob Hope generation become middle class, greatly magnifying their impact on the economy, making $50,000 a year instead of $10,000, scrubbing for potatoes and getting a beer or two a week. And then the baby boom comes along, the biggest wave in 250 years, and exaggerates demographics even more. Greatest boom in history. I picked this up in the 80s and said we're going to have the greatest boom in history, and it's going to peak in 2007. So this was my first breakthrough after I did my, ever heard, Malcolm Gladwell's book, Outliers? 10,000 hours of immersion to master something. That's if you have the capacity and if you're serious about it. 10,000 hours. Well, I hit that in 1988 and bam. Got this indicator, peak spending, 46, rises sharply, raising kids, kind of plateaus 39 to 54, biggest home spending, late 30s, early 40s, biggest car spending and other appliances, and then downhill after the kids leave into retirement. So peak spending, 46, move forward the birth index, 46 years. Now, is that a complicated indicator? 46 years for the peak of a generation, as if the generation was one big person, predicts booms and busts almost 5 decades in advance. So I get this in 1988 and say, holy shit, the baby boomers are just starting to accelerate, or still early stage. And guess which country at that point had a peak in their baby boom spending curve? Japan. Economists said in 1989 Japan was going to overtake the United States and become the #1 economy in the world. They're just extrapolating their S-curve acceleration and their baby boom at the top as if it's going to go on forever, and there aren't cycles. I said Japan's going to crash in the 90s, and US and Europe are going to see a decade better than the roaring 20s, and people thought I was what? Fucking crazy. That's what they thought. Except for stockbrokers. They didn't care if I sounded crazy. It was a great argument for them to sell mutual funds in the early 90s. And I got known for Dow 10,000 by 2000 in the brokerage industry in the early 90s when the Dow was 2,000 to 3,000. And people thought, we're a sunset country. Japan's taken over. We don't have work ethic. We don't blah, 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 blah. We're done. And then boom, greatest boom in history. So that's how I got known. Predicting that with one simple indicator, but it wasn't the US boom. More astounding to predict the fall of Japan when they looked invincible. Because everything has a cycle. They were just early on the baby boom. You see now, if you go out, the millennial generation, people say, oh, the millennial generation is bigger than the baby boom. No, they're not, as a wave. Bob Hope, 3-foot wave, baby boom, 10-foot, millennial generation, 4-foot wave. Anybody ever surfed? I only did for 1 year before I realized I was too old for that shit at 35, okay? Too old. Difference between I die on a 10-foot wave, I'm not gonna die on a 3-foot wave. That's the difference in magnitude of this generation. So we're going more sideways, and in 2007, on a 46-year lag, what did the stock market do? It peaked October 2007, started to crash. 2008 looked exactly like 1930, major banks and companies, including GM and AIG, going under, and then the Fed just said, what? So here's how they ruined my perfect little chart. Quantitative easing. These are still the fundamental trends. Why we have a slow 2% recovery despite trillions of dollars being thrown into the economy like cocaine or heroin, like feel good, everything's fine again. Banks can get liquid. People can speculate on Wall Street and borrow money at 0 rate. I mean, party time in a downturn. Stocks are now a little more than double the value they should be by fundamental trends. How did this happen? Now, I could spend 30 minutes on this, I'm not. Quantitative easing not just made profits higher for companies by lowering borrowing costs to 0 and adjusted for inflation long-term borrowing as well. They, more importantly, allowed companies to buy back their own stock. Do you realize that all the net buying of stock since 2009, if you add it all up, not foreign investors, not institutional, not retail investors, net, all corporations buying back their own stock with free money, courtesy of the Fed, who gets their free money, what? By pulling it out of thin air. Does that sound like a way to create sustainable growth? Don't think so. So I'm not a big fan of QE, but I'm pissed because they ruined my perfect little fucking chart, okay? That's what I'm pissed about. So do you think I like central bankers? So I like you guys. You guys are the ones going to take down these central bank, top-down economy that's been reversing bottoms up since electricity and the automobile. And this is just, it just keeps going. Top-down is dead. I was talking to these people right here, running nonprofit organizations. Everybody's a little business. Everybody's a project. That's why companies can run from the bottoms up, organize around customers, not management in the back lines, and management can disappear. My phrase is, management's the problem, not the solution. Managers, like all of us, have genitals, emotions, and egos, which gets in the way of good decision making, okay? Software doesn't have this problem. If you take the expertise of these professional managers and bureaucrats and put them in the software at light speed and put them in the hands of frontline workers so they can know their customers and who's profitable and how profitable their operation is, get rewarded on their operations on a P&L, then you got middle-class workers that aren't going back to assembly line. They're becoming entrepreneurs in a corporation that has a brand name and capital and structure and systems and information access and all this cool software, so you don't have your dick in your hands trying to run a dry cleaner on Main Street, scrapping to make an ordinary wage and losing steam. That's the future. Bottoms up, network. So, what does this tell me? We're going to see the biggest crash since 29 to 32 ahead. And then the next generation will create a boom, will not be as dynamic as this one, but where do you think the dynamics will be? How about India? Think China's done well the last 30 years? India is just about where China was before they took off. And India's got even more people, and India has higher GDP per capita at their urbanization today than China had at their point. India might be richer than China, and China is still an emerging country, despite all the progress. GDP per capita, nowhere near ours. They just got a lot of people. So this is how they created that. Profits grew at 175% with GDP growing 44%. That's the weakest recovery in all of history that I've seen. Weak recovery, but profits 4 times that because of low borrowing cost and all the leverage that caused in the economy. But you look at the top line, black, earnings per share grew 119% faster than earnings. Stocks follow earnings, but earnings per share, because companies have bought back their own stocks and keep shrinking the float, they're getting a huge bonus. That is what creates the difference in the stock market. Has no relationship now to the economy because they're on a leveraged earnings per share run with free money by the Fed. Japan. I always tell economists, why is not everybody studying Japan? Japan's baby boom peaked in 42 to 49, 2 peaks, decades before US and Europe peaked. Their baby boom came first. What did they have with the peak of their baby boom? A bubble in real estate? Yes. Bigger than ours. A bubble in stocks? Yes, almost as big as ours. And what did those bubbles do? Crashed when their demographics turned around, when the fundamentals failed. Japan's real estate went down 67%. Almost 30 years later, guess what? How much is down? 65%. Barely bounced. Even with the next millennial generation, also small compared to their... Didn't come back at all. Why? Now there's more old people dying than young people coming along buying homes. Dyers are sellers because homes last forever. Real estate's never going to be the same in most developed countries because the baby boom's going to die here over the next 26 years, and net home demand's going to go down even in a boom. But Japan had their downturn, their millennial generation, not a big bump. People say Abe's arrows are driving the economy. Well, free money always helps, but they have this bump. This bump ends in 2020 and turns down even lower. Japan is a dying country in front of our eyes. Who comes next? Italy, Portugal, Greece, Germany. European Union peaked 4 years after the US in 2011, demographics. They go down forever. No millennial generation to ignite a second boom. Europe is dying, and Germany is one of the leading countries. People keep saying, well, Germany's going to save the European Union. I'm like, well, who's going to save Germany? Germany looked like Japan did to me in the late 80s when I said Japan is a dead man walking. They just have a lot of exports. Well, exports are not going up in a slowing world, and they're going to go down a lot more. Germany's going to be in the most trouble. Can only see this stuff looking under the hood at the fundamentals instead of the symptoms. Economists are stuck in symptoms. People are stuck in symptoms. The reason 1% of the people make all the money in the economy is those are the people that look under the hood and take risk. You have to take risks to get beyond being a doctor and making $300,000 a year. The top 1 and 0.1% take risk, and that comes from starting businesses and new technology. That's where real wealth is created. Look at Germany. Look at their echo, their millennial generation. Nothing. Dying country. Now, summarize the world, because I could spend an hour on this. There are 6 smaller countries in the developed world that have millennial generations due to immigration, with the exception of Israel. Israel's still reading the Old Testament and having a lot of babies and obeying God and shit, okay? They still have a lot of kids. Even most affluent people in cities have fewer kids between 1 and 2. People on farms had 5, 6, 7. Free labor. Cheap to raise on farms, you know? You want some milk? Go milk the cow, you know? Australia, the strongest. Israel, New Zealand, Norway, Singapore, Sweden. 6 small countries that have echo booms, millennials, that look almost like the baby boom. 6. Not going to cause enough growth for the world. Sustainers, like I showed the U.S., moving sideways. Canada, Denmark, France, Switzerland, UK. Northern Europe, Northern North America. Everybody else, all rest of Central and Southern Europe, East Europe, Russia, East Asia, including China, an emerging country, all decliners. Demographics go down, down, down as far as the eyes can see. We're at a watershed. Developed countries peaking, emerging countries are the new growth. India is the next great boom. Here's China, the first, just like Japan was the first developed country to peak in demographic trends. China's the first. 2011, workforce peaked, is declining modestly. 2025 forward, off a cliff forever. China's aging, will get old before they get rich. They will never see in my lifetime developed country status. 40, 50, 60,000 average incomes. They're at 10,000, 20,000 adjusted for purchasing power, but actually, no, they're more like 14 adjusted purchasing power. They may get up to 17 to 20. They're not going to be as rich as us, but there's 1.4 billion. This chart should strike terror into the Chinese government, but I guess they haven't even, well, they probably have figured out, they just won't tell us. The green lines are actual workforce growth. It has been declining since 2011. The blue lines are these rural migrants that move into cities to get better jobs, but they are the lowest paid, second-class citizens. Their kids can't get educated there. They can't get health care, what little they have, any welfare, no benefits. They're like illegal immigrants in this country, but they're living in cities, and they're treated that way by the elite middle class in China that makes $10,000 a year. They are going home. China's whole drive has been moving people from rice paddies to urban centers where you get a 3 times GDP increase with no increase in education. Of course, once you move to cities, your education increases, your job, just because of much better job markets and specialization. So China understood that better than anybody. They've been pushing it. The problem is China's been building shit for nobody. Is that a good business strategy? Ever seen that work out? 22% condos in cities in China are empty. The worst cities, 27%. 30 to 50% overcapacity in everything from aluminum to cement to steel. Does that work out well? Well, Chinese buy empty condos and keep buying them. The developers aren't stuck with this shit. Chinese people have 80% of their wealth in this stuff, and they're going to lose almost all of it. Biggest collapse in wealth, making Japan's 90s collapse in real estate look like nothing. That's inevitable. Not only are people not moving into cities and increasing rates, they are literally going back to the rice paddies slowly. Back to the rice paddies where they can breathe, don't have to fight traffic, don't get treated like second-class citizens, and can afford the real estate. They have to pay the highest real estate prices in the world compared to income. Twice what Sydney or Vancouver pays, and that's the highest in the developed world. Twice. This is the future, and this is typical of emerging countries. A lot of countries in South America peak around 2040. You go out to Middle East and Africa, it's at 2100 plus, but the typical emerging country is in Asia, is typical of India, will peak around 2055 or so. Now you guys, I gave you guys my slides, so you guys will get these slides. You can take pictures if you want. Catch me, good angle. And India only tailors off slowly. And every time I've looked at India, every about 10 years, updated this chart, it only tends to move forward. But this is the future. India is the next China. I think the fall of China, I think China is going to see the biggest downturn when it happens from massive overbuilding and capacity, the biggest real estate and stock bubbles in the world. And it's going to take them 8 to 10 years to recover. And the world's going to say, what's the next big thing? I think it's going to be India, as long as they don't screw it up. And India's very socialist, could screw it up. But Modi's this new trend. If they can just keep going in that direction, where is the Western world going to put its money when it's got nowhere to invest in an aging societies? They're going to put it in the next China, which is, India is the only one with scale to do it. And Southeast Asia are my two bets for the future. Now, real quick, this is macro. It's just as true at the micro level, from cradle to grave. Remember I quoted potato chips at 42? People weigh the most at 60, eat most calories at 14. Guess when people say they're the most happy. Just take a guess. Well, this one they didn't narrow down. I would get it to if I had the data, I'd get it down to the year, but 60 to 65. Right about it coming into retirement, just before you have your first health scare. I looked in all my family, early to mid-60s, when most people got their first cancer diagnosis or stroke or heart attack or something or dementia set in, whatever. That's when people are the happiest. Age affects everything. People go through a life cycle on every stage. Is youth different? You know what causes inflation? Young people. What do young people cost? $300,000 for the average to raise, not counting college. And what do they produce? Nothing. That's inflation. People. I've got a whole inflation indicator more accurate than any other one. That has nothing to do with oil prices, money printing, anything, just people entering the workforce at the peak of their expense and investment cycle. Then they get married, 26. This is all baby boomers. It's about a year later for the first stage of millennials, and about 2 years later it looks for the next stage. Apartments, when they get married at 26 peak, kids are born 28 on average, and you buy a home as fast as you can, 31 for starter homes. But people buy their biggest home at 41. Now, I would have thought peak income, mid to late 40s, you'd buy your biggest home. No, 41. Here's the reason. Here's what I figured out. If the kids were born at 28, how old are they at 41? 13. What happens at 13? Fuck you, you know nothing, and I never want to be seen with you in public ever again. That's what happens at 13, roughly, depending on the kid. That's when you want the most space in your house, okay? My sister had a nice house in a great up-and-coming neighborhood in Spartanburg, which was booming because of the tire plants and auto plants or whatever there. She could not sell the house. On the market for 2 years, not even a bid. Real estate agent didn't figure it out because they're not the brightest people in the world some of the time. My sister finally figured out. All the bedrooms are on the top floor, master bedroom here, surrounded by kids' bedrooms. Nobody wants to be near these nasty little teenagers. That's the reason they couldn't sell the house. Furniture peaks with the peak in spending, college tuition, more affluent people, 51. Following high school peak spending, autos, 54, hospital, 60. Now, travel's interesting. People obviously travel more when their kids leave the nest, mid to late 40s, and they keep traveling internationally till about age 60. Why do they slow down? How many people travel a lot? Travel's stressful. That's why people do get private jets if they can afford it. Right? Jet lag, Montezuma's revenge, customs and waylaid and stuff and all this stuff. Then they say, okay, put me on a cruise ship. Stuff me with food and booze. No repacking. The destinations come to you. You get off the ship, go have a dinner, come back, same room. They're happy. Now, this was my last survey. We're just updating the consumer survey. We do it every year. It's a massive database. Takes us a lot of money and time. First one I pulled out was cruise ships. It's now 80. People, they say cruise ships, newlywed, nearly dead. Now it is nearly dead. People are literally going on cruise ships till they enter the nursing home. 80. Because anybody can do it. What is the thing I see booming the most in the next 2.5 decades with the baby? Remember, who's the big wave? Who's the 10-foot wave? Even when they're old, baby boomers. What's the last thing to peak? Nursing homes, age 84. Who's in those nursing homes? Men don't live that long, right? Women, 10 to 1. I've been in a lot of them. I tell men, if you can just last till 84, you can have more sex than you ever had in your life. I didn't say good sex, okay? Nursing homes, 84-year lag, 2019 to 2045 will be the last great real estate boom of the baby boomers, and nobody will ever build enough of them, and the service is terrible at high prices. There's going to be billionaires made in the nursing home industry in the next 2.5 decades, guaranteed. Most people won't see it coming. So again, even though the economy booms and busts on this 46 to maybe 47, 48-year lag, every sector has its own life cycle and peak. Now, I knew a long time ago when people had midlife crisis. I had no question about this. Didn't have to ask my wife, who's a psychotherapist. I just look at the motorcycle chart and say, that's it, 45 to 49. That's when people buy the most motorcycles. I call it the last great orgasm for men. You ever hear Willie Nelson recently say, I didn't think I'd outlive my pecker, you know? Men start to say, you know, I better get it while it's good. I may look hot. Motorcycles, sports cars, mid-40s. We predicted the Harley boom and the Harley bust. Now, part two, my other thing, businesses and technologies. Technologies raise our standard. Quantitative easing is like getting high on crack and then it wears off and you're back on the street, you know. Technologies change the way we work and live, make us permanently richer time and time again. And technologies are just S-curves, exponential. Technologies grow exponentially, not linearly. People think linear. People walk along the ground and think the world's flat. Is the world flat? No, it is round. Is the world linear? It looks like 3% a year. And, you know, take a couple of years around, 3, yeah, 3%. No, compound that, what do you get? Exponential growth at just even 3%. Everything compounds. So technologies grow exponentially. S-curves is the progression, innovation, mainstream, maturity. And when an old S-curve is starting to slow, the new one emerges. So internet is peaking. If I just look at your industry, internet is peaking, the next stage, the next great thing. In this arena, because there's a lot of things, biotech, nanotech. You know, nanotech makes shit out of nothing? Sounds like central banks almost, you know? That's got to be incredible when it happens. But crypto and blockchain is happening now. It is coming as internet matures. And that's the next thing. But you're still in this early stage. So, S-curve. First project I had at Bain & Company, Firestone Tire Company, making radial tires, because that's what they always made. Who do we compete with? Goodyear and Goodrich. Well, we walk in, knowing nothing about that industry, and say, oh, by the way, did you notice that Michelin and Bridgestone just passed you in global market share, and they're making all radial tires? 7 years to get from 10% to 90%. That's 7 years, that industry. We caught them in the middle and switched Firestone to radials as fast as we could, just enough to save them from going under, not to make it. If we'd have caught them 5 years earlier, we could have made them a great company. They could have been Michelin and Bridgestone. Companies do what they do and stay with it, and then somebody does something new and passes them by. So this is totally projectable. Automobiles is the best documented and very similar to what you're going through. 1900, after being invented in 1886, 0.1% ultra rich. You know what 0.1% is now? Billionaires. Relatively, that's what it took to afford a car when they first came out. 1907, Model T design, when 1% could afford, still small, but made it more affordable. 10%, the killer app, assembly line. Cars become massively affordable quick. Everybody wants one. You can see them now. farmers used to shoot it. You know, these cars come over the road, they'd shoot at it. They thought there was alien invasion or some shit. You know, they didn't know what it was. That's the tipping point, 10%. And then it accelerates, and surprise, and this is something I would have never known without studying this cycle. The first big shakeout in an industry, you get shakeouts in the early stages, and you're going to see that, but the first big shakeout comes right in the middle of this S-curve acceleration between 40 and 60%. Because when it takes off, everybody enters, everybody invests, this race for leadership, and they overinvest, like China does for a living. But they overinvest, excess capacity, shakeout, fewer companies survive, and they ride it to maturity. And there's a second shakeout when it slows down, and then that's when the new technologies, they're going to transcend that takeover. S-curve, nothing more predictable and projectable than an S-curve. It's key to know where are you on this S-curve. So where are you on this S-curve? It's crypto, Bitcoin, blockchain. Less than 1%. I'd say you're halfway between 0.1 and 1%. Good place to be. And in about 20 years, like cars, you will be balls out mainstream. As Michael Turpin said the other night or something, I heard, 10 years from now, this thing will be, it'd be a whole different place. That's an S-curve, because it's exponential. It takes a long time to grow from nothing to that 10%. 14 years for automobiles, and then in 14 years, they go from 10 to 90, 10 times the progress in the same time. Exponential. 4 stages. Innovation, that's the stage you're in. What's going to work? We don't know. It's a question mark. Is Bitcoin going to be? Could Bitcoin be big enough in value to be the standard for currencies? Well, certainly in the standard now, because it's not big enough and it's more volatile than gold and stocks. So that's not a good currency standard, but the theory is here, and I think it's a damn good theory. Bitcoin keeps gaining value. It gets into tens of trillions. It could become what gold was for the economy. That's Bitcoin. That's one thing. Blockchain technologies are a whole other thing. All types of micro sectors that can be improved beyond the internet with blockchain technologies. More efficient, faster, more secure. Internet 2.0, from my point of view. Those are two different things. Because I don't think everybody, maybe everybody has a coin, somehow the tokenization, but I don't understand that part. But I know that everybody can't be the standard. Now, when the internet emerged, who became the standards? Intel, Microsoft operating systems. IBM at first for the first mass computer. You needed to be a standard around everybody can go. So that's somebody's going to become that standard for your industry, and then there's going to be all these applications that are going to grow exponentially. Growth boom, still way ahead. Shakeout in maturity. This will happen this will take 20-some years to play out. And all of history, I'm oversimplifying. There's always clusters of technologies. It wasn't just automobiles, it was electricity, the light bulb, phones, all these sort of things. Internet, it actually started with portable computers, cell phones, operating systems. That was the first wave of that S-curve. Second wave was internet, broadband, and all that sort of stuff. So S-curves break into S-curves, as I showed. But every 45 years, now this is one of the most clock-like. Commodity prices peak every 30 years like a clock. Technology cycles peak every 45. It took me a long time because I was trying to tie it to young people innovating in generation cycles. Didn't quite click. But I keep going back, and I got a lot of long-term research. Steamships, 1875. Railroads, 1920. Automobiles, 1965. Internet, 2010. 45-year clock. And you're part of the next clock. Biotech, nanotech, blockchain. And again, internet was the second wave of the last 45-year cycle. You're the first wave of the next one. You're part of it. There's other technologies. 3D printing. And this is going to solve a big problem. Remember I said about demographics? Everything's just slowing. Even third world countries are going to go down to 0 by the end of this century or before. Well, what if we lived to be 120? Oldest people today. With all these new biotech, 3D printed organs that you don't reject, and nanobots that go clean out your arteries so you can eat French fries all day and still not die. You know, it'd be nice, wouldn't it? If we lived to 120, people would be in the workforce twice as long, so twice as much demographic contribution, get much smarter, richer, and stuff. And I will tell you what I will predict today will happen, not in my lifetime, but in my kids. People will grow old enough to have 2 sets of kids. You have your first ones in the late 20s, early 30s, once you start your job and family. And when they leave the nest, you go maybe travel the world for 5 or 10 years, get a PhD in something, change professions, and have a second career and a second set of kids in your 60s, let's say. Because you can live to retire to 100 and live to be 120 somewhere. In the workforce twice as long, 2 sets of kids. So you can even have 1 or 2. Now, the first set of kids you make all your mistakes on, right? Second set, perfect. Turned out perfect. So I would require, as president of a country, the second set of kids have to pay for the therapy of the first set of kids. That's the price for being perfect. So again, predictable. The next big S curve is starting. This S curve will move mainstream in mass, and you may be before that and some technologies later. Nanotech will probably be the last because it's the most gee whiz, making shit out of nothing. You can't beat that, okay? 2032. Now, I learned another thing about this technology. The technologies peak, mature, hit that 90%, like in 1830 for factories and the steam engine, 1875 for steamships and then McCormick Reaper and stuff like that, railroads and telegraphs, 1920. But there's always what we call a hype cycle, an emerging new bubble in the new technologies coming off the great success of the old technologies, so it gets overhyped. And that's what's happening now. So that extends the stock market side of this another 7 to 9 years. Railroads literally peaked. I'd show you the graphs, but I don't have time. 1920 fell off a cliff as automobiles and trucks and buses moved. And you know what the Great Depression was? It was a tractor bubble and bust. It was a farm bust more than anything. Real estate wasn't. People couldn't afford it. I mean, you had to put 50% down on a 5-year mortgage. How many people could speculate in real estate back then? But 9 years later, the first car bubble. Then, of course, there was a second larger one to follow that. So every 90 years, now I have my co-author on 0 Hour, the latest book, about a year ago, always told me his most important cycle is a 45 and a double 90-year cycle. Well, I didn't have a reason. I have to have a reason to preach something. I got to prove that it worked in history and prove that it's going to happen in the future. Well, finally on this, if I take this 90-year hype cycle at the end, I can pick up every major bubble since the Industrial Revolution. Every 90 years, we've had major bubbles and great resets, great depressions. Not depressions or extended recessions like the 70s, great depressions. But everything bubbles up, and then everything gets shaken down to reality. The leaders emerge, and the leaders go on to glorious heaven. In a boom, they dominate. Now, that's the thing about when a bubble bursts, there will be a shakeout, and the companies that survive will do the best. I'll look at this a little later. Now, part 3. What is this? Anybody know what this is? It's a scientific study, by the way, just a hint. Male orgasm. You cheated. You've seen this before. It's the Masters and Johnson's male orgasm cycle, documented scientifically in the late 1950s. Desire, excitement, final push, orgasm, bam, over. So you know how many people tell me China's going to engineer a soft landing? Oh, you know, the tech stocks can engineer a soft landing. It will not happen. My guarantee. When people say that to me, especially if they're male, I say, how long can you keep an orgasm going? And they shut the fuck up right there. End of argument. Once it happens, women, we're done, okay? We don't have time to cuddle and talk and, you know, da-da-da. We're done. Women get 3 and come down slower. So women have the better deal in the orgasm cycles. But bubbles follow this. I've brought this back years ago. 20 years ago, I used to run around and use this as a joke. I say, look, bubbles are just orgasms. Boom. Dow 29. Exponential rise, final blow off, bam. Bubbles burst twice as fast as they build. They're already exponential, much faster. I can put this model on any stock market, any growth in history, and tell you if it's a bubble or not. Looks like a bubble, quacks like a bubble, walks like a bubble. It's a bubble. The entire 42 to 68 bull market in stocks, 26 years, did not have a bubble in it. And the corrections were never more than 20% until the whole thing ended in the 70s, and we had 73, 74 crash in 88. Not bubbles. We're in a bubble era. Everywhere you look. Nikkei was the first. Why don't people look at Japan? The first bubble. Does this fit the model? Yes. Did it crash twice as fast as it built in 2.5 years? Yes. Did it wipe out most of the gains from the bubble? Almost all? Yes. That's what they do every time. The NASDAQ, the biggest bubble we've seen until now. Bubble up, crash. Shanghai, the fastest. 2 years, up 6 times in 2 years, down 70% in 1 year. Crash twice as fast as the build. 2 years to build, 1 year to crash. What does it do? Wipes out most of the bubble. Are bubbles a black swan? Are they hard to see? I mean, they kind of go out of the way like, here I am, you know. How could you miss a bubble? How could economists say, well, nobody can predict bubbles. Nobody can. What? They're the most predictable thing. There's a reason people are bubble blind, and it's very simple. When you're in a bubble, let's say in an economic bubble, stocks are going up 20, 25% a year instead of the normal 7 to 10. Houses are going up 10 to 15% or more instead of the normal inflation, which is 3% in recent time. You're getting a free lunch, sitting on your ass on your couch, and everything's going up. You're not having doing a damn thing. You're high. People get high on bubbles. What do people who are high want? To get more high. What does a crack addict want? More crack. What are we getting ever since this bubble started to burst in 2007-8? More crack. More free money, more crack, keep the bubble going, and they've created a bigger bubble than ever. I'll show it. Bubbles are temporary, but they're a sign of something. Bubbles only happen when things are very good, and then human greed builds on top. You don't get a bubble for no reason. In this case, we're getting it because of massive money creation. But normally, the 90s bubble, technologies were on their S-curve, internet, baby boomers were in their peak growth and spending, which I could see coming decade before, and everything was hunky-dory, and then people got crazy on top of it. People keep bidding on something once it starts going up. Bubble model. I first is tell what's the trend coming into it. It's not the last low. Where do we get to the point where stocks or any trend starts to diverge from the fundamental trends, which you can predict in a lot of things, and start to go up more exponentially? And of course, you don't know when it's going to actually peak, but you do kind of know when you're in that final phase, which we're in now. Since Trump got elected, we're in that final orgasm. The markets don't give a shit. Trade war with China don't give a shit. Trump's got fucking more lawsuits against him and legal challenges than any president. Makes Nixon look like nothing. They don't care. As long as they keep getting accommodation, they go up. As long as companies keep buying back their stocks and earnings per share go up. So, as long as it takes to go from the bubble origin to the peak, it will crash in half that time. And I can tell while the bubble's building, once I determine that bubble origin, all the way up, I can tell you, here's your downside. It's going to go back near the bubble origin. And so there's nothing unpredictable about it. The most unpredictable thing is when does the crazy thing peak? Because it's, you know, orgasms are crazy. Now, here's an asymmetrical trade. When a bubble bursts, when you get in this final phase, options are going to be on anything are going to be what? Super cheap. At the January 2018 top, which was the first in a while to look like it could have been a bubble top, the way it went up, the whole pattern of it. At that point, I call my guy, Rodney, and say, Rodney, how much would it take me to hedge an entire stock portfolio against a 40% drop in the first 2 to 3 months? And his answer was 2.5%. Options to 6-month option to give you some leeway to catch that first 40% crash and to offset that 40% decline. That's a 16-to-1 payout in 2 to 3 months. So this is an asymmetric trade. Things go one direction, options get cheap. You may have to do this a couple times. We'll look at Bitcoin in a minute. It makes this look like nothing. But that is the typical. I've averaged out 7 stock bubbles in the last century. The average was 42% down in the first 2.6 months. The NASDAQ was right on that 41%, 2.6 months. Then you get a counter trend, about 50% retracement, sometimes 60, and then it just goes down, 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 eventually back to the bubble origin roughly, and that takes, this was right on the prediction, 2.5 years in the tech bubble. Here's Bitcoin. Goes up 1,390%, greater than tulips, greater than internet. Internet was 498% in the thrust. Down 49% in the first week after peak. 49% in 1 week, 1.7 months, 69%. Now, interestingly, I'll come back to this later. Bitcoin and gold. I've got bubble models for real estate and everything. They're a little bit different, but I got bubble models, and they work 90-some% of the time. Bitcoin and gold, and Bitcoin more, did follow the bubble up, did follow the bubble crash first, and then basically held at higher levels, and they didn't go back to the bubble origin, which tells me it's not over. That's what it tells me, even short term. Here's the internet bubble. Again, 489%. Most of the NASDAQ bubble in 99 was the internet stocks, and internet were part of the NASDAQ. Cryptocurrencies are not part of the NASDAQ, or we would have a bigger bubble in NASDAQ. Now, real quickly, I could spend an hour on this. I'm not. I have over 30 years, I started with the demographic cycle. Very predictable in any country in the world, and all countries are a bit different. 45-year, I tell you, technology innovation cycle. Goes up and then kind of crest in maturity while the new build until they accelerate again. And when 2001, when 9/11 happened, I was sitting there saying, okay, stocks are about to bottom in 2002 in our cycle, and we're going to see another bubble just like the first one. Dow's going to go to 35,000. Well, we called the bottom, October 2002, but it only went up to 14,000. I said, oh, shit, something's changed. Well, I go back and find geopolitical cycle, positive 17 to 18 years. When the world looks crazy like now, the premium, the stock price earnings ratios are lower than they would be, 50% lower. So that's a big deal for stocks. And I've got a sunspot cycle, and boy, do I get shit for this, but it's the best cycle I've found. So that's the difference between me and an economist. I'll look at anything if it makes sense and if I can document it. 88% of recessions back to 1850 in the downside of sunspot cycles. 11 out of 11 major financial crises or depressions in the down. 11 out of 11, 100% in the down spot. And we're in a down sunspot cycle right now. As Bob was talking to me earlier about, sunspot cycles be getting lower and lower. We may be going into a cooling period despite CO2 in a decade or two ahead. These cause the cyclical movement. Have you noticed? Think back, since I've been alive more than a kid, early 60s recession, early 70s recession, early 80s, early 90s, early 2000s, and then 2008 to 9, a little early. These sunspot cycles are 8 to 13 years, not 10. And scientists can predict them, I can't. I just look at the best scientists. And they say the danger is the greatest in the next year and a half for this down sunspot cycle. But the point is, all 4 of these cycles are down between 2019 and 20, and most of them are down into 2022, 23, before they one by one start to turn up again. If we're going to see a big bubble crash, it should happen in the next year or so. And who's going to survive it the best? This is the greatest indicator that I did not invent. Lacey Hunt, who I have speak at every one of my conferences every year, is a classically trained economist that somehow didn't get screwed up like other economists. He still gets it right. And he understands what's real and what's not. And he's got money velocity. When it's growing, investments are productive, and those productive investments create more jobs and profits, and then those will create new investments, and you get a positive dynamic. Money velocity will tell you when that peaked in 1997 and 98 for most countries, including the U.S. When it is down but still positive, you're getting into a speculative stage. Money's going into bubbles and speculation and stock buybacks and all this shit that doesn't create the returns to pay off those investments and reinvest again. So that doesn't last long. I look now, when people say, okay, currencies are going to go bust because everybody's printing money, I say, well, wait a minute. Who's the best house in this neighborhood? Currencies trade relatively. They don't have a value like stocks do. Stocks are 10 years of earnings discounted at a 10-year treasury bond discount rate to get to present value, plus hype and price earnings. But that's what they are. There's a formula for valuing stocks and bonds. There isn't one for currencies. They trade relatively. U.S., despite decline, 1.43, 40% higher than Europe. India is way higher than China. The point is the two countries I've been bashing the most for my entire career are Japan, because of aging and increasing debt with zero interest rates, living off of crack, and China building infinite shit for nobody. That's what they're doing. And I could go in that for an hour. Unbelievable what they're building. Go over there and see how much empty shit there is in China. And people holding real estate there with 80% of their net worth, the average family there, think it can keep going up when it's already twice. Hong Kong is the most overpriced city in the world in the developed side, in China and the emerging world, and is the most overpriced real estate residential compared to income. China, 0.47, Japan, 0.55. So when the world goes to shit, which currency is going to do best? US dollar. Now, I'm hearing from crypto, blockchain people, well, US dollar is going to crap. Gold bugs tell me every day. Peter Schiff lives right down the road. He'll say this all day. Dollar's going to go to zero. I'm sorry, Peter. In 2008, the dollar went up 30% when all other currencies went down, and gold went running for mommy, and silver even faster. So those are not the safe haven currency. You guys are going to be competing against the US dollar if you want to be a standard for value, not gold, and not the yuan, at least for a while. Now, real quick, short-term predictions, including you guys. This was the final, looked like could be a final channel of this bubble. They usually end in an exponential channel. They usually do an overthrow, but then they got to break that bottom line. We didn't do that in the December crash. So I say this isn't over yet. And now we've had a big, strong rally. We would have to break 2,300 on the S&P 500 to start to worry about maybe that could have been a top. That is not looking likely. I've been telling my subscribers for months, I'm looking for the bubble crash more than anybody. My view is have this bubble crash, get it over with. If we'd have let this happen in 2008-9, we could have been over the Great Depression and deleveraging by 2010-11. Over it like we were in the 30s. But nope, created a bigger bubble, so now we have to burst again. This does not look like the beginning of a crash. And I've been tracking the NASDAQ, the lead bubble, versus the 2000 crash, looking for that. Is this looking like a 41% in the first 2.6 months? Because I don't want to wait to tell my subscribers when it's down 40, oh, by the way, the bubble's over. Well, they've already gotten their ass whacked. I want to see, is it following this? No, just in November, we should have been heading down even harder, and we didn't. I said, okay. Not looking like a crash. It means another bubble. Now, we're going up exponentially, so if I look at the lead bubble, where do I project the NASDAQ's going? I go through the tops of a logarithmic and exponential graph, and it said the next bubble, it peaks like later this year, early next year, by my best estimates, 9,400 plus, and it's likely to go over that. So 9,400 to 10,000. That's where I think the NASDAQ's going. Final bubble. Bubbles go out on bangs, not whimpers. And the September, October peaks in stocks did not look like a bubble peak like January did. So I've been like, nope, I want this bubble to be over, but damn it, it ain't going to happen yet. Now, this is the best chart. And I struggled with this for about a month. Look at all the bubbles. What I found is, of course, the trends in a bubble are exponential. So each wave of it goes up steeper and makes more gains in a shorter time. But the line in the sand that determines the bubble's over and what flies forward is the linear. So you got exponential on the top side, linear. So you got like this expanding triangle. That's the best way to look at it. The NASDAQ, much more than the S&P, would have to break 5,500 to say this bubble's over. And if it can hold there, the next projection would be that 9,400 plus, maybe 10,000. That's what I'm looking at for my subscribers. This bubble is still in play until we break critical support. And I'm more concerned about the NASDAQ than the S&P because that's the lead bubble. The NASDAQ could run and make this damn new high, and the S&P could only retest their highs if it breaks 2,300, which does not look like it's going to happen. Bubbles are progressive, so this is just a classic bubble progression. First wave up took about 6 years to go 3,900 points. Next wave up, 38% of the time, about 2 years. Next wave up, 1 year or less, 3,900 points. That would put the NASDAQ, if we hold the December lows, which again looks likely, 6160, would project 10,100 within a year. Now here's my view, very simple. And it's going to be a little different than people think in this industry. If stocks bubble again, it is a slam dunk that Bitcoin and cryptocurrencies are going to bubble up and even more. They are following. The internet was the big bubble at the end of the tech bubble. It only came in the last wave up. You guys are that last great bubble showing the future next trend in advance. That's what's happening here from my outside point of view. Dollar is likely to correct. It already is a little bit, maybe 94, maybe 89, but when the crash comes, the dollar is going to be the safe haven, and U.S. 30-year, 10-year Treasury bonds and AAA corporate bonds, the same investments that did only positive investments in the 1930s, while everything else reset. Gold, I predicted the crash and said, hey, it's going to go back to near 1,400, then it's going to fizzle again. Gold is not the safe haven, but it is holding up better than other commodities, which says gold still has some of this kind of, a little bit of safe haven or crisis thing, but it's not really. Gold is an inflation hedge. Now, this is what, again, remember I said gold, and this case, Bitcoin, is basing out much higher than the first internet bubble did, which again tells me, I'll show you. I mean, you guys corrected 87% between late 2013 and 2014 and 15. That was just the first wave up. I consider this the third wave up we've just seen. It could go down to 2,600 and would still be in my value wave for a one final bubble. I'll tell you how I got the 32,000 number. I kind of pulled that out of my ass, kind of didn't. There's a reason for this, but it could be higher. Because you guys know more than anybody how Bitcoin and cryptos move when they move. 1,300 to almost 20,000 in 7 months. That was the last bubble. I have never seen anything move like that. And here's a leading indicator I found that when China starts clamping down on capital outflows, which they've been doing, then people cheat. They start papering invoices from Hong Kong, all this sort of stuff, and they start using precious gems and cryptocurrencies and Bitcoins to make the transfers. So this is an indicator on that saying, gosh, just now, with a lead on Bitcoin, we ought to see, a major move upcoming, and it's going to continue for a while. So this is presaging another major move, probably starting very soon. Now, here is the second scenario. The first one is a fifth wave peak. Well, oh, by the way, let me go back to this real quick, because you got to make this point. This is the same thing the internet did. The fifth wave peak would then lead to a bigger correction, and then you have the longer scenario, which I'll show in a minute. But just note, it means a bigger correction after that. It's not the end. This is an alternative scenario in which, and I think people in this industry may favor this more, we do have this meltdown in the economy, and people say, where do we run? Screw gold, screw stocks, screw central banks. We run to cryptocurrencies and maybe Bitcoin. This would follow a nice 4-year peak in each one of these bubbles. So late 2021, 32,000 plus. This is not my favorite scenario because I've shown everything from RCA coming at the end of the auto bubble in the 29th, the last year, and taking over, internet coming in the last year of the first tech bubble. I see you guys as the greatest bubble in the late stages of a great bubble. And again, this is a sign of what's the next technology wave. Radio and TV were the next big thing after automobiles and that sort of stuff, and they were bubbling up at the end, that sort of thing. And again, I would look at you as something like the internet on a 20-ish year lag. So let's say we do make this peak late this year, 32,000. Now, this is where I'm just following the internet roughly here, that's how I got my 32,000 number. This could be 50,000 for all I know. I mean, literally, this thing moves. So that's just my best estimate. Big crash, and then the beginning of a long boom. Now, the secret is this doesn't really tell the story, because this is the whole banana. What really happens, here's a case, Amazon, in the internet crash, one of the big survivors, and they wouldn't have been too hard to tell that they're more likely to survive than a lot of the dot-coms going under. 95% crash, and then a 372 times gain from the 2001 low, and the last wave up recently, 619%, 7 times gain, and I don't think it's over yet. I think there's another big run up, so it's going to be 10 times gain in just years. I mean, so that's what happens. The companies that survive will be the ones to invest in. You got to ask, is my company, do I have enough substance or scale or whatever? I have a market niche that's real, or do I just have a coin that's going up because other coins are going up? That's the big question to me. A lot of companies going to go under. A lot of dot-coms went under. Even Webvan, I like that sucker, man. Deliver the groceries to my home. Okay, so why am I in Puerto Rico? Now, again, I think this crash is most likely to top between September this year and January next year, but it could be wider. It's hard to predict, but I have 2 indicators that suggest that range, and they're ones that people don't look at. So the crash starts in 2020, takes a few years to work out, but again, you're going to know this thing's over when the NASDAQ's down 40% or more in the first 2 to 3. That's the only time they'll say this bubble's over. Until then, it's not. I'm in Puerto Rico because of this. I bought a 25-acre property in 1996 after discovering Culebra in 1993, and been coming here ever since. Pain in the ass, like he says, taking me fucking forever to build this house. We're on the far side of a small island off of an island. And that's what I bought. And I've been coming here, and while I've been coming here 25 years, San Juan has become a real first world city. It was not. It was a shithole city 20, 25 years ago. Pardon anybody out there. It was. Had no interest in San Juan when I first bought this property. I was only interested in the island. This is a great place. I moved here before I got Act 2022. I moved here just to get a condo on the beach for a quarter the price of South Beach, where we would have moved back after my wife caretaking her family. And now I rent my property in Culebra. No taxes on that. 4% taxes here. I'm more Act 20. And cost of living cheaper. And I got Act 20 because I run into somebody in my newsletter that said, Harry, why aren't you in Act 20? I said, too complicated. You know, like that guy on Ameritrade, you know. I got to hire 3 people and fake all this shit. You know, my computer guy is now my head of technology. My wife's the head of marketing. Come on, I'm not going to do that shit. Come here, they slot me into their corporation, 1 consultant, done. I didn't even apply for Act 20. I had to apply for 22. So I'm here for the lifestyle. I moved here before I got Act 2022. More people ought to be looking. Everybody in the crypto industry should be looking at this place. And anybody in investment management or service should be looking at this place. So thanks for being a good audience. I think I overran my time. Thank you. I got time. I do have my dog's 15th birthday to go to right after this, so. Yeah.
So, first of all, thank you for a very direct, very insightful presentation. Black and white as they get.
Yeah.
I learned an interesting fact today, and it may be an interest for a lot of folks here. A lot of technology companies or up-and-coming projects. We lived in the last 15 years on the S-curve called technology adoption curve. You're probably very familiar with.
What's it called?
Technology adoption curve.
Oh, yeah. Actually.
Right?
That's what the S-curve is.
That's the S-curve is. And what I've seen in today's presentations, the number of the pivoting point where it goes from early adapters to the mainstream that averaged about, if I remember correctly, about 1.5, 2.5, and most of the slides today was shifting towards 10%. And it kind of starts aligning with most of the unicorns out there that they don't get to the mass to around 6 and 10% anymore. Yeah. So the question is, by your assessment, has that fundamental adoption curve now shifted to that 10% mark before mainstream? Or is it still an old 1.5% pivoting point? Sorry for a long question.
It's still earlier for you guys, which is a good thing. It just means you got longer to boom and much more potential than most people think. That the only hard thing about the S-curve is you have to define the S-curve. What is the adoption? If you define, in cars, the only way to plot an accurate S-curve in the early 1900s, you had to cars per family in cities, because you could not get out the country. There's no service stations, no roads and shit. So, and 50, 60% of people were still in rural areas. So the first bubble were cars moving into cities, 1 car per household. The second wave was much bigger because it was 2 cars per household, all people. Cities, suburban, and rural. So again, S-curves on S-curves. So defining the S-curve is the hardest thing. If you define that, it will plot and it will track. I don't know how to define yours. I just say intuitively. I still say you're at the same place of the internet about 20 years. 2019 is 1999 on the internet. That's the best estimate I can make, which says you got at least 20 years of boom and you're going to be super mainstream in the next 10, 20 years.
Quick. No. So the follow-up question to that, we're kind of, it's more of applicable maybe to me, but again to some of investor life cycle. There is this 2% of the 2% on the top, and it almost appears that none of the downturns and upturns affect them or their spending or their life cycle of spending. Is that still correct, or they do follow the bubbles as well?
Okay, let me give you a quick example. Anybody see Ted Turner on TV in the early 2000s? Ted Turner lost $9 billion, 90% of his $10 billion net worth, and he was crying on TV. People are saying, Ted, you're still worth $1 billion. What the hell are you crying about, you little wimp? The guy lost 90% of his wealth. He can't save the bison. He can't stop global warming now. He was devastated. It's relative. This is the hardest thing for me because I talk to rich people. I don't talk to Homer Simpson. They don't have any money to invest. They're not going to hire me to speak, okay? Rich people own the financial assets that have bubbled up. Homer Simpson doesn't own shit. $110,000 home in Dayton, Ohio, and $30,000, $40,000 in some plan or pension. That's all they got. Rich people own all this shit. They're the ones that take the biggest hit. The top 1% controlled 50% of the wealth in 1929, and after a long shakedown, 35% by large set. They still own 35%. They're still rich, but the ratio gets shifted. Rich people get, if you're buying very high-end real estate in places like Manhattan, Miami, London, Sydney, Australia, you're going to get your ass kicked the most in the high end. Rich people say, we'll always buy these places, and there's always going to be us. No. You guys lose the most at the end of the bubble. You make the most, you lose the most. What goes up comes down. My rule in real estate, stocks, any bubble, the greater the bubble, the greater the burst. Is Omaha bubble? No. Is it going to burst much? No. Does anybody ever fucking want to live there? No. That's the reason. The best places bubble the most. Again, the sign to me, as little as I know about your industry, that you're the next big thing is how much you've bubbled in this early stage. That is the sign. But you also have, you're still in this high phase, and you got one bigger bubble burst ahead of you, and then you got a long, incredible boom.
Okay, so this is a crypto kid, Justin. I'm over here. That was a great talk. Regarding the decline of Japan, the literal death, as you phrased it, because of the population change, have you factored in the effect of AI augmentation and how that might be sort of a virtual population overlaid on top of the human population that would have other effects besides like housing, and I don't know what AI would want, but it's like an extension of ourselves and almost like a virtual overlay on the human population.
Yeah, my theory is more China's going to take them over and turn them into slaves. But yes, who has the most interest in robotics right now? Japan. They have a lot of old people. No, they need robotic bedpan people, That's what they need. Japan, AI, all of East Asia has this aging. They're the up-and-coming thing, but the East Asian parts, not India and Southeast Asia and all of that, but the tiger countries and China increasingly in the coastal area, they are this aging society. And yes, they are probably going to end up leading in both robotics and AI because they have the most compelling need. Japan's aging faster than us. All us, South Korea, Taiwan, all those countries, except for Singapore, aging faster than the US. So that's a huge incentive, and they are the leading edge, so they're eventually going to be leading edge in technology. We're still leaders in a lot of places, but that's going to pass. My view of the US looking at the long-term thing, we see one more great boom into 2036, and then we really start to fade. We're still going to be up there. It's going to be us and China, India up and coming for a long time, but we start to fade after 2036 because our demographics keep fading until we start living longer, and that's going to take a long time to hit. And then that's going to hit Asia all as well, and biotech. So yes, I mean, AI is incredibly important and robotics for these aging countries, but you still have aging people that are declining in their spending rather than young people that are rising. So it's still a demographic disadvantage. But yeah, would it be nice to have robotic bedpan guy? Yeah, sure. Messy, stinky thing. Why not have a robot do it, you know? Perfect.
Final question.
First, thank you for the presentation. I really like the focus on demographics. It was an interesting way of looking at all this for me. What is the role you think of U.S. debt in these projections of yours? I mean, well over 20 trillion. So what is the role of debt in these bubbles that you're
First
going
thing,
through?
when you're looking at debt, what people miss, they always look at government debt. And Australia's got almost none, China's got, way above, and U.S. is up there. That's a quarter of our debt. A little over 100% of GDP. And economists, they do some good stuff now and then by accident, have proven that above about 80, 90%, it starts to weigh on the economy and growth. It slows GDP growth. We're there already. Most European countries are there. Italy's at 160. Japan's at 260%. How do they sustain that? Zero interest rates, which they've created with quantitative easing at 3 times the rate. They have printed 100% of GDP. We printed 24, euros printed 42. That's the difference in money printing. So Japan has to work harder at it. So it's the private debt. When we go into this downturn, it's the private debt that will deleverage. Government debt will only go up. More entitlements as we age, more social services in a bad economy, and lower pay-in to Social Security, Medicare, and government taxes. You're going to see deficits of $3 trillion, I think, before it's over, a year. Thanks to Trump's tax cuts, which he gave to corporations right when they have the highest profits as a percentage of GDP in all of history. Not going to look good historically. Gave the stimulus to the wrong people at the wrong time at the top of a bubble. So the debt, what happened in the 30s is the private debt deleveraged massively, brought debt ratios way down, and then the growth of the economy was very strong after the 30s. There's nothing like a great detox to get the economy healthy, get rid of a lot of debt, and grow again. You shed a lot of weight, like you go from 400 pounds to 100, so you're running faster. So we had this incredible boom to follow, and that lowered the debt. The government debt is a percentage of GDP, but the private debt got massacred. I think you're going to see private debt, my estimate, in the next several years, 100 to 120 trillion out of 300 trillion private debt disappear. Restructured, written down, and that's a good thing. Bad if you're holding those bonds, bad if you're Wall Street, and they deserve it, those fuckers, okay? Very good for the economy to shed that. Debt reduction is what a depression is. It's a deleveraging of bubbles. Financial assets go down 70, 80, 90%, wealth disappears. Loans get written down or default, money disappears. So how you get deflation, and why I disagree with the gold bugs, you're only going to get deflation out of this. You got fewer dollars chasing the same goods. In a slow economy, that's how you get deflation in prices. But the big deflation is in financial assets, and that's where the rich get hit. The rich do not know what's coming at them. They're going to be crying like Ted Turner, I was worth 10 billion, now I'm worth $1 billion. That's what's going to happen. That's deflation. Thanks again.
Thank you, Harry. So interestingly enough, Harry's projection for the 32,000 Bitcoin scenario 2, fourth quarter of 2021 is exactly where I see it as a chart, and I see it between 30 and 45,000. So, And I then see CoinAgenda of 2022 being about 10 times the size of what this is, because everyone's going to say, wow, it's 35,000. I better learn about it. At any rate, I project next year will at least be double this size, because Bitcoin will be double, and pretty much the size of CoinAgendas can be a multiplier effect on the price of Bitcoin. Which, by the way, we're getting close. We're down 0.4% since the start of the show. We're going to risk, if we don't get a little bit of an uptick this afternoon, being the first Coinagenda doesn't have a bump. Oh my God. Okay, so we have some great companies that are building during this downturn, where a lot of the best companies do, and we are running a little bit late, so we're going to have two before the lunch, and then we're going to have the rest afterwards. And we had one that I believe is no longer presenting, so we should be more or less on time for the final party. And there's a little joke, of course, among all CoinAgendas, if you've been here, that we kind of have the old timers panel as something we can throw away if we want to. It's about 2/3 of the time it does. I think there's been two that have actually been held. Okay, so without further ado, first up we have an STO from TapJets, and Eugene Kesselman will be presenting. Eugene? Okay, great. Okay, no problem. Sure.
Because I'm short and the podium will. I need the clickers. And if you can turn it on so make sure the red light. That would be good, but it will turn automatically. There's no need for sound.
Since I hate dead air, are we ready? Okay. Oh, no. I was just going to kill time until you were ready, but if you're ready, go for it. You have your mic.
First of all, thank you, Michael, for putting on an event. It's always a joy to come to your events. And it's always important for me when I go to those events. It's not about really STO, it's about being part of a community and sharing the message of what we do and the vision of what we do and how we do it. And it's always, when I do those presentations, I hope for two things. That everybody at the end of presentation will grill me. Because you guys in the grind every day, and you have an opportunity to ask some of the tough questions that might save my bacon when I'm in front of a very important person, right, or doing an important deal. So please don't hold back and get your cameras out. There is work to be done in a second. So if you got QR code readers, get them ready. So starting March 1st, and I'm going to derail again, and I'm a bit nervous. I'm usually not nervous on stage, but this is epic for us because nobody knows we're doing STO. This is where it was born, March 1st. We actually delayed it to the 15th. March 1st was the original date, but I wanted to come here and kind of give it a final spin with the right people in the room and having Michael and then others comment. But now, everybody will tell you if you're doing STO in the United States, you got to put the first slide that looks nothing like your product. It talks about this is an offer to sell securities for accredited investors only, blah, 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 and a link to securities and registration. And some of you who are planning to do STOs, maybe that's just kind of a deck that is worth following because we had so many attorneys now look at it, it's scary. Uber, Lyft don't own a single car today. Airbnb doesn't own a single hotel. Amazon, Facebook doesn't create any of the content. Those are the largest companies in the world. I want to introduce you to TapJets. We don't have any planes. I'm going to skip a few slides. If you're flying private, you're that top 2% of the 10% rich folks. And once you fly private, it's addicting. You don't go to TSA again. However, to fly private, You either have to own your plane, this is the coolest way to do it, but very expensive, buy fractional memberships, join memberships like Down and Declining Jet Smarter, and I usually don't talk bad about competitors unless they owe me money. And they do, they were a customer, they're using our platform to buy flights for their clients. I'll explain that in a second. Or you call a broker or a travel agent equivalent. And when you do that, what he does, he has a Rolodex of airline companies he works with. He tries to call and figure out which jet can take you somewhere. Usually when he gets 3 or enough, he sends them to you with a markup of about 15–20% average. And in the end, you make a decision and use a fax machine or a scanner to do all the transaction. It's so antiquated, it hasn't changed in 10 years. But here's the bigger problem. In the United States, and let's just talk the United States because the market is much bigger, but the United States is the largest market. There is about 5,000 planes operated by 1,000 companies that are legally can fly charters. None of them are interconnected. There's only one company called Marketplace called Avinode that has a database and it'll send them your request and it has some pricing idea, so it'll tell you approximate price, but you still got to do request for proposal, or request for quote and response. It's hideous. And those people are not changing. And it's so fragmented, they don't know who is where anytime. So that's a big logistical problem. So how do we solve this? Classic chicken and the egg concept was, well, why don't we build an app and sell jet flights? Sounds like a great idea. Well, you can't sell what you can't buy because you can't price it. And then you're back to being this back end, 4 guys in the office getting quotes, and it's not real time. Now, we said, okay, but we got to build the best user experience ever. It has to be as easy as getting an Uber. But to do that, we had to build a platform that tracks every single charterable plane, but not just a plane. Just because you have a plane in the airport doesn't mean there's 2 pilots to fly it that are well rested and within the duty time. And even if you have them, it doesn't mean that if you fly it, it's 5 hours, that some part on that plane might not be due for maintenance. And that plane still needs to have time to fly back. It's a very complicated logistic process, and if you think of Uber or Lyft, they do this kind of with the cars, right? But the most exposure they have is the city limit. I have worldwide. The logistics involved are hideous. So how do we do this? How do we track planes in real time with notifications, just like an Uber does? And we do this by building an app for the operators that pilots have connected to their aircrafts, if it's a new model, because some of the aircrafts are 30 years old, it uses built-in GPS and iPad, but everybody now has electronic flight bag called iPad. And that software feeds into the calendar that is managed by the operator, that feeds into, think of it as the largest Google Calendar of airplanes available today, 3,512 aircraft. Why do we do this? There is no platform for a consumer to buy a plane today, except TapJets. Brokers have Avinode, we just talked about it, but consumers couldn't do that. No marketplace. The flight goes to Miami, and it has to come back to their home base. All those empty legs are offered to brokers and to Avinode. Half of them are not even priced. Why not build an eBay where you can bid on the flight that's flying empty anyway? We build that into a product called Flight Auctions. And there isn't a kayak where you can go and say, show me all the jets that are in Puerto Rico in the airport right now. There's 9 of them, 3 available to go. 7, the rest of them was turboprops. We pulled it in real time. We can do that. When you download the app, you have this access. A lot of people tire kick in our app. So let's talk the market size. $37 billion US alone. Quickly, and there's their pointer here, total charter flights. This is not private flights. This is not NetJets fractionals. This is on-demand charter. Approximately 1.1 million. These right here, 67%, slightly more than that, are brokered flight on papers. Those are brokers. ACS, Magellan, there's a bazillion. 3,600 in US alone for 1,000 companies who fly planes. It's 4-to-1 ratio. These guys mark up 15 to 20%, and they do it on paper. and they don't get you the closest airplane. They get you the fastest one they can call. So what does it translate to? 1.1 million flights. Brokers sell about half of it, right? 67%. That's 14.6 billion. Average charter flight is 29 grand. It's 146 million in commission. If you just go after that broker market, not inventing a new space for cheaper flights. We don't compete on price because we don't control the supply, right? Supply chain sets the price. Planes are expensive to fly. But what we can do is we can find the closest so the total cost of the trip is cheapest. What this means to us, if we get to 5% of a market share, so this is about the 2.5 curve of adoption, but not conquering the world, because we can't conquer the world. It's just not realistic, so let's be realistic. That will translate to about 146 million in primary commission revenue and 44 million in this auxiliary auction sales. We have 17,000 clients booking auctions. They're subscribed to the city pairs, they go often, and there have been sales of a $900 a trip to go to Aspen from Houston. Right? Those are great, great options to go. So quickly about the company, I'll speed up. I don't know how much time I have, but I'll go as fast as I can. So quickly about the company. My partner who started this whole crazy idea was a former chief pilot of United Airlines. They kicked them out at 65. What an inhumane airlines. This is the person who 50 years flew, got to the top, biggest captain, has issued more licenses to pilots than FAA for Boeing 777s. And he gets kicked out and he says, I want to fly. Let's go buy jets and you build an app so we can sell them. We bought 3 jets, we flew the wings off of them, and we realized 3 jets are not enough. That's how it all started. Quickly from there, in 2016, we released an application, both Android and iOS at the same time. 2017, we realized if we go to New York, we got to come back, so we got to sell it on the auction, and there was no way to market it. We started taking cryptocurrency because it was a boom, there was a lot of wealth created, and we said, why not? And this is when we started our smart contracts. We'll talk about it in a minute. It kind of came together. We have a rewards program because everybody wants to buy jet cards. And we said, jet cards? Why would you give some company $500,000 up front and wait to use it? We're going to give you the same benefits if you commit to a rewards program, but you hold on to your money. Huge, huge success for us. And that's kind of where we at from that regard. Let's quickly talk about the team. I think there's smart people in the world, and it comes down to execution. Collectively, we have 120 years of aviation experience, logistics on moving aircrafts. All of our developers and the team, we've been working together for 15 years. We understand each other's without finishing typing the sentences. And it's super important if you want to get complex products out. And all of us came from a Microsoft development support backend from a development side. So it's a great team to work with. I encourage everybody to download, but I'm going to show you a recording, but you can do it on your phone today. This is a real product of what would it take to book a private jet today. This is how our customers do it. They will log in using any kind of authentication they like. They will pick to and from the airports, the dates, how many people, and in real time, select any available jets. Just we look up today in Puerto Rico. After they finish browsing, they'll pick one and hit confirm and pay, and they can select cryptocurrency. You're done. That jet is in that airport. We were confirming this morning, and it's ready to go, and the crew is ready to go, and the maintenance is tracked. I'm going to skip the auction example in the interest of time, but I'm going to go to one more example because we had to pivot, as any company does. We went to a customer, and we said, look, we built the great app. You can book something in 30 seconds. And he looked me right in the eye, high net worth guy in Houston. So what, I can call Joe Broker and tell him, I want to go to Las Vegas tomorrow, 6 people, and hang up. And I'm like, oh shit, how do we compete with that? So we said, oh, Siri. Well, Siri's not where everybody lives. We want to live where you live. You got Telegram? You can now add TapJets bot. You got Slack, add TapJets bot. You got Skype, add do Skype. Facebook Messenger, I don't care what you are. I don't believe in apps long term. I believe we gotta work with you wherever you are. If you're executive assistant sitting in a corporate Skype for business, we're there. Cortana, we're there today. And this is how it works in Skype scenario, or Skype for business scenario in this case. Facebook and other platforms are already added, so the video is a little outdated. In a natural human language, you will type out exactly what you need. I know you say, I need a flight from Sacramento to Las Vegas tomorrow for 6 people. It'll tell you all airports in Sacramento. It'll tell you options in Las Vegas. And within 7 seconds, it will give you options to choose from. And you can pay with the currency of the platform you're on. So if the Facebook issues the Facebook famous token, we will accept that. With that information, ooh, that looks weird on this computer. So that information, just like in the Uber, and I hate comparing ourselves to Uber, but once you finish the booking, it goes through a safety audit or a dispatch process, gets sent out to those available aircrafts, pilots hit accept or whoever's designated dispatcher is, and it goes to electronic flight back of the crew. One of the coolest things we do, the TapJets hates us for, is when you drink on our planes and you eat cookies or special peanuts or you like cranberry, the app will scan the barcodes on those bottles so we know your preferences. There is a place in the app to put what temperature you like while you're flying. So even when you go to a different airplane with a different operator, those pilots are aware of your habits. And it will do everything in power because they want to work with us to accommodate you, or at least tell you, sorry, we don't have a cranberry, but we came up with this instead. If we know they don't have a cranberry, our concierge will, for some high clients, we kind of monitor the process a little bit today just to keep them happy. But that's how we interconnect from the consumer through the entire experience. And while we're not the driver of the Uber, we have visibility and control of the end-to-end experience, which is important for consistency of service. What we can do, aircraft maintenance management. I want to know it's a safe aircraft. I was showing Michael earlier. I can tell you how many hours this pilot has, what is his medical status, when was the last flight, when did he flew last. And here's what happens, and I want to talk about it for a second because you will share it with your friends. If you're flying to Aspen, and I have 2 pilots, one has 12,000 hours, the captain, but the company assigned a 200-hour first officer. Is that a safe flight? Any guesses? Legally, it's absolutely safe flight. But our system throws an exception for a human to interact. Our director of flight operation looks at it and says, what's the weather in Aspen? Is it an icy runway? And if we don't feel comfortable, we protect you from that. No one does this real time in 30 seconds. We don't put a plane that has a risk even in your queue. So when you book, we know we passed the minimums, but we go above and beyond in that regard. So what does it take to do this? I'm gonna geek out all the technology guys. Okay, I'm gonna speed this up. This is all good. 82 data sources. We collect quote data, pricing data from a market. We look at every broker request, digital or otherwise, and because brokers are cheats, they ask different companies at the same time. So we have to deduplicate all the requests to really understand what the market demand is. And we process it on the inbound. It requires an exception handling we talk about. Then we take scheduling data, supply data, and lastly, we take weather data, fuel cost data, landing fees data, everything that makes up that pricing mechanism. We run it through what's called the data enrichment process. Because sometimes broker writes, I need OW pricing for SAC, and nobody knows what it is. It's a one-way price to Sacramento. So we know that Joe Broker uses that shorthand. Machine learning, after 3 corrections, remembers it, and now we know every flight the broker requests, right? So think of the complex stuff we do. Then we put it in a modeling mechanism where we can do forecasting pricing. We have a global calendar, which is an open source that all operators connect to, and that gives us opportunity to become a service. And how we sell it is really irrelevant because it's an API. Any company can connect to us right now and book a flight instantly. They just have to license it. Every flight is a smart contract. I'm not going to dwell on it. Everybody knows what escrows are. But the operator, the broker, we, and the fuel companies are in a contract. And the payment is released when FlightAware says the plane is landed. That's the safest way to distribute the money. Quickly on the numbers. Product been out about 2.5 years. We have 5.8 million in sales. The year before 3.2. It's 81% year over year. About 798. It's actually there was last booking that didn't make this charge. About 909 again in profit, and we did 220 flights. Notice the average ticket price goes down as we become more effective. That's our user base, active users only. We don't count registrations and downloads because that's like in 90s, it's meaningless how many visitors you have. Active users means they've done something on our platform in the last 90 days. Looked at the auction, interacted with us. They're not dead. They didn't look at the price and went away. Everything that is in gray, that's the aircraft inventory we have in real time. And when we say partner, they don't make it to our slide until we did business and spent money with them. This is not a list of airlines. We have paid those people money to date. They're all sharing the calendar with us. Those are some of the biggest names in the industry. 3,100 planes. Everybody can say they have 10,000 planes on Avinode or 5,000 planes. We have 3,152 schedules. 11,000 airports where we collect fuel, landing fee, customs, and other data. And the customer flies with us 98% of the time. They do it again and again. That allows an exponential curve because we have to catch them once and they'll continue to buy, right? The cost of sale is once. Now we can screw up, but to date it's 98%. And an average person in that segment, if I'm not mistaken, flies 2 to 4 times per year. So you do some potential modeling here, and this is what you arrive in. We have beat our 2019 numbers. We're very close. We're going to blow through this number. How is it going to scale with economy downturn? Don't know. But it's a very conservative model if you look at the number of flights compared to 1.1 million flights in US alone. And that's pretty much it. I'm going to show you slides that usually come up with questions real quick. What's the milestones? Where are we going? TapJets Asia, licensing deal for us. We own 49% of that entity. They do all the sales, all the expenses. We just license them the software. And they sell the flights in Asia. There's a good organization. They're good people. TapJets Europe, we already have an office because we had developers there. We sold about 17 flights last year in Europe. So we've not officially launched there, but that's coming. Plane Factor 2, remember the application I showed you for the pilots? It becomes an open source calendar to everyone could subscribe. So Fly app or any other people can subscribe to a calendar, and it's going to be an open source scenario. And payments, we call it a Friday night dilemma. How do you pay a $100,000 flight on Friday night? If you're cryptocurrency, great, but 80% of people, 90% of people I know don't do cryptocurrency payments yet. So what they're going to be able to do, they're going to be able to do a preloaded card into a stable coin, right? Pre-buy it with a fiat, and then spend it anywhere in that ecosystem all of those operators. They don't have to buy from me, but we're going to become a payment system like Visa and MasterCard in that regard. What are we raising in STO? $6 million, 30% of the company, very generous share, for a full common stock, which is shares, votes, and dividends. A very transparent scenario for the company, and most of the money is not going to technology. It's going to sales and marketing because we're ready to grow. We can scale. 220 flights on our system don't even make a CPU go over 0%. Anybody wants to know what competition is doing? Those are the guys who can buy us on any given moment today, except Victor, they're about to get bought. But when you go end to end, because of how efficient or how close we can position the aircraft, our average price per hour is super great. And when we combine it with the rewards program, it's like the best jet card in the industry. And this is it. Thank you. TapJets.io for investors, TapJets.com for if you want to book a flight.
Are there any questions? Okay, so next up we've got Zero Chain. Let's see. Oh, there you go.
Sir, do we have the clicker too? Sorry, the slide clicker.
Oh, here it is.
What's going on, guys? Just waiting for the slide to come up. All right, looks like we're ready. My name's Derek Fiebiger. I'm Director of Operations with Zero Chain. I'm also Chief Investment Officer of a digital asset hedge fund called Arturo Capital. And I want to thank you guys for having me. It's really cool to see all this enthusiasm around crypto down in Puerto Rico. I'm a resident. I moved here in June. So cool stuff, but enough about me. I'm here to talk about Zero Chain. What is Zero Chain? Zero Chain is a next-gen blockchain platform that enables a fast, decentralized cloud to run on top of its consensus layer. How did we get here? Well, Zero Chain came to be as a result of an ambition from our two founders, Dr. Siswata Basu and Dr. Tom Austin. At first, Siswata and Tom sought out to build an IoT dApp on top of the Ethereum platform, but they quickly realized that wasn't possible. Let's switch mics here, or maybe not. So they sought out to build a dApp on top of Ethereum, but they quickly realized they couldn't accommodate swaths of IoT data on top of its consensus layer, both from a performance and cost perspective. So they sought out to build a blockchain platform that would enable them to build a fast, low-cost blockchain and one that could store a ton of data. So we ICO'd at the start of the bear market in February 2018, which was less than ideal. But we've kind of just had our heads down in development ever since. So CTO Siva Dorislas kind of embodies our development team as well. He's brilliant. He's the architect of our consensus protocol, and yeah, we just have a really solid development team, and we're collectively days away from launching our work. So why Zero Chain? Well, the average person spends about 4 hours per day, at least, on the internet. Probably for you guys, a lot more. This leads to an accumulation of massive amounts of data, and most of which is stored on centralized servers and monetized by big corporations. We're quickly realizing with this growth in data accumulation that there is an increasing amount of data breaches, and it makes your personal information vulnerable to identity theft on dark markets, among several other concerns. In comes Zero Chain. We started out just trying to make a fast cloud on the blockchain, but over the past year, we evolved our product line to 3 core products. The first product is a fast decentralized blockchain consensus protocol. The second is a storage app accessible on your phone and desktop. And then the third is we invented a new crypto wallet that enables secure fund transfer via your mobile device. So first, let's talk about our blockchain. So our consensus, but you can play this video too if you want, kind of get a good idea of how we do it. Our consensus protocol is unlike anything out there in the space. I'm sure you hear that a lot from different blockchain or infrastructure projects. But what I mean by that is most of the infrastructure you see is either proof of work, it's DAG, it's DPoS, but we're really, really unique. The only really close similarity is Definity. We're using a verifiable random function to select our miners, so you can't really know, there's no sequential order of the proposer and validator of the block. And this creates really fast deterministic finality in a Byzantine environment, so you get really, really fast confirmation. In Q4, we ran a public testnet with 6 billion transactions processed without a hiccup, and we achieved 1,000 transactions per second with 1 to 2 second transaction fidelity. And that's the key thing, is the transaction fidelity. Bitcoin takes around 12 minutes, Ethereum about half that, and then most other really fast protocols, they're not going to get guaranteed finality for maybe 5 seconds at some of the fastest. We're 1 to 2 seconds, so that makes us really, really effective. But the best of all is we're incredibly efficient and lightweight. What do I mean by lightweight? And this is the key thing that makes us really unique. Oh yeah, that's the video there. So, like I said, verifiable random function and lightweight blockchain. Lightweight. So, we're dividing our architecture into three different silos. Where most blockchains just have miners that validate and store the ledger history, we are the only known blockchain that divides up these duties. The 3 different silos are miners, sharders, and blobbers. The miners generate and validate the blocks. The sharders store the blocks, which include the ledger history and the text, also known as structured data, so just kind of like ones and zeros. And then the blobbers store the unstructured data, so like files and photos. They take on a lot of that type of storage. By separating out these duties, each silo is able to specialize on their tasks, and the result is an incredibly clean and fast ledger for processing transactions. So why are we doing it that way? For what reason? Well, most layer 1 blockchain platforms, they're building something really fast or interoperable or some other buzzword feature, but they're only releasing that layer 1 platform without designing anything on top of it. Since we built Zero Chain from the ground up with a fast decentralized cloud storage solution in mind, we built an app to go with it. The app is very similar to storage apps like Dropbox, but the storage is decentralized, of course. Here's a sneak preview of ZeroBox, our latest iteration of the iOS app, which will be available this month with AlphaNet launch. So that's just. Coming up here is one of the cooler things about our Zero Box app is you'll be able to upload videos, and then content creators as well will be able to stream video, and then we'll also have a share link, something that we call share link, where you can monetize content in a decentralized fashion. And AlphaNet is launching within the next week or two. So you'll be able to try it out and download it. All right, sweet. Then our other product that I mentioned is Zero Chain Wallet. So I manage the Telegram chat, and I get a lot of questions regarding like the hardware wallet integration. Everyone's asking when Trezor, when Ledger Nano S, and this requires to take a developer team to integrate with Ledger, and you're pulling valuable developers away to do something like that. So Saswata kind of went aside and was like, you know what, let's just make our own wallet, and let's make one that's a lot more efficient and convenient to stake from. So we consulted some of the top cryptographers and cybersecurity experts in the world, and we came up with something that we call the, 1 sec here, 2DA Secure Wallet. What's really cool about it is it has the convenience of a software wallet or a hot wallet, but also the security of a hardware wallet. So this benefits you from a staking perspective particularly. So how does it work? Well, the details can be found on zerochain.net if you're very technically inclined. We have an academic paper out that explains all of our split key technology. But the gist is kind of like the layman's term is you generate a seed phrase. This phrase is then split up and stored on 2 devices of your choosing. We call this the split key feature. And once this is activated, you now have a passwordless login system where you only need to enter a PIN on your main device, confirm with your second device, and then you can send, receive, lock ZCN from the convenience of an app, but again, with the security of a hardware wallet. So that kind of summarizes the core things that we're doing at Zero Chain. It'll all be available for you to try this month. So I recommend you guys checking us out, downloading our ZeroBox app. But if you guys have any questions, I'll open it up for questions. But I want to make one last note. We have awesome tech with actual deliverables. We're not just making ideas and promises like a lot of projects out there, but we're very under the radar. We're looking to ramp up our exposure, so that means that we're looking for marketing partnerships, exchange partnerships, and people that want to validate and stake and provide services on our network. So if any of that interests you, please come find me or just check us out on the website and let us know. That's it.
Questions? Okay. We get you the microphone.
I'm a witness on Steam and also a block producer on EOS, so we can geek out later. I'd definitely like to talk more about it.
You're probably a little bit more technically inclined than I am, but I can do my best.
I was wondering about I was looking on the website and the FAQ, how are you going to do your token distribution as far as like how much goes to your team? I know you got your mainnet launch coming up, and I saw there's some details about that, but I didn't see it in your slides. I was wondering, can you talk a little bit how are you going to do your initial distribution, and is there any stake-weighted anything as far as the mining process, or is it just completely this random function and it doesn't matter how many tokens you have? Is there any governance to the tokens?
We're using so yeah, is that everything? Because I can start. I'll try to work my way back. So we're using a squared staking mechanism. You can look at our consensus protocol. So it does the the more tokens that you have, the better chance you have at validating blocks and earning more tokens. So I think Dfinity really differs in that sense. But as far as our token distribution, we actually are already liquid. We're on exchanges, not very good exchanges, but I believe it's, and Will can correct me on this, it's kind of all off the top of my head, but I believe about 20% of our tokens are liquid right now. 80% is locked up, and I think around 30% of those are team tokens, which we're considering giving to either service providers, people want to blob on the network, and then we also have another 10% or 20% that is allocated for future reserves if we need to find more investors in 1 to 2 years. And then we also have like a foundation allocation as well. But the main thing is the token value is very important for our ecosystem. And without it, it kind of, if everyone was to dump the tokens, it would destabilize our network. So we're trying to, Hashgraph is kind of doing something similar where they're holding on to a core amount of the tokens, both from a Sybil resistance standpoint, but also to kind of build up the token economics as well.
One last question. Oh, Sybil resistance mechanism.
Is that
With a question mark, yes. I want to know if you had it.
What is our Sybil resistance mechanism? Could you kind of give me like a for instance, like which type of Sybil attack were we talking? Like just if someone gets a lot of tokens and tries to destabilize our network, or?
So is it just proof of stake? So the honest majority assumption is that no rich guy is going to have 1/3 of the coins, or?
Yeah, to start, it's
okay.
Yeah, we're kind of we fall into the 2/3 Byzantine resistance. But once it gets over that point, then it's that's another reason why we gotta keep an eye on our supply, especially since we're a much smaller cap coin at the moment. But yeah.
Any other questions? Otherwise, lunch. Okay, lunch it is.
Thanks, guys.
And again, it's a plated lunch again, so just stay where you're at.